Good afternoon. A warm welcome to each one of you. As all of you know, we are conducting a webinar on corporate tax. In 2018, UAE had introduced VAT, and after 4 years, they have come up with another tax regime that is corporate tax. We, Alchemist Accounting and Consulting, is here to guide you through corporate tax. Alchemist Accounting has been providing service since 8 years in the accounting industry and is one of the top accounting firms in UAE, providing tax advisory support and consulting to businesses. Today's session is being presented by Mr. Afzal, Managing Partner of Alchemist, and Mr. Shaibin, Director Taxation. Mr. Afzal, Managing Partner at Alchemist Accounting, has over 11 years of experience in finance, UAE tax advisory, audit, and consulting. In addition to helping businesses operate efficiently in the Middle East, he also provides practical solutions in compliance with legal professions. And Mr. Shaibin, Director Taxations, hold over 10 plus years of experience in the field of financial accounting, direct and indirect taxes, and other consulting and compliance fields. In Alchemist Accounting, he plays a lead role in bridging the tax and compliance advisory needs of various businesses and industries across GCC. Please note that there will be a Q&A session. So if you have any queries regarding corporate tax, you can mention it in the Q&A section, which you can find below in the meeting control. And also please note that for not using the chat session. All the questions will be answered towards the end of the session. And also the webinar will be recorded. So we will be sending it to you via email. So let's begin. I invite Mr. Afzal to continue with the session.
Hi, good evening, everyone. Thank you all for joining us. As we all know, corporate tax law is going to be effective in UAE from June 2023. If we compare with other countries in the world, even to GCC countries, including Saudi, Oman, Kuwait, or Qatar, UAE is having its lower corporate tax rate of 9%. Apart from the lower tax rate, when we go through the provisions of the corporate tax law, we could see almost 70 provisions are there. All these provisions are made with a very easy and progressive approach. In this session, we will go through all the important provisions of the corporate tax law and let's understand how it impacts our business. I will be covering the basic overview of the tax law, including its background, effective date, applicability, etc. And my colleague Shaibin will go more detail into the interesting provisions of the tax law. Let's go through quickly through the timeline of UAE corporate tax law. Ministry of Finance announced the introduction of the corporate tax in Jan 2022. Later, in April 2022, Ministry released the public consultation document along with the FAQs. There were many representations made after that. Then almost 8 months later, on 9th December 2022, Federal Decree Law number 47 was published by the Ministry. As per the law, corporate tax becomes effective from 1st June 2023. Now, many of us will have a question that when an entity needs to compute its taxable income and start paying the corporate tax to the authority. First of all, we should understand that an entity needs to compute its taxable income for its tax period. And an entity's tax period is always its financial year. So what is an entity's financial year? The period for which the books of accounts are maintained or financial reports are prepared. Again, if an entity is not maintaining proper books of accounts, to understand what is the financial year of that particular entity, you can go through your memorandum of association, then you will come to know what is the financial year for your entity. Each entity can choose their own financial year. Normally, generally speaking, most of the companies follow Jan to December, but it is your own, based on your own discretion, you can choose your financial year. It can be April to March or July to June. So now we understood that the entity's tax period is its financial year. And the question is, which will be the first tax period for an entity? So let's understand this way. The first tax period will be the tax period commencing on or after the effective date of corporate tax, meaning 1st June 2023. So if your financial year is Jan to December, let's say, then your first tax period will be the financial year immediately starting on or after the tax effective date. So in this case, if it is Jan to December, then your first tax period will be Jan 2024 to December 2024. Let's say if you are following the financial year of July to June, the first tax period will be 1st July 2023. That is after the effective date, right? Effective date is 1st June 2023. So your first tax period will be from 1st July 2023 to 30th June 2024. Here, the question, another part is that the due date, due date for computing the taxable income and paying the tax to the authority. Due date as per the tax law is 9 months after the end of the tax period. So in the first example, if the company is following a financial year of Jan to December, the first tax period will be Jan to December 2024, and the due date for paying the corporate tax to the authority will be September 2025. That is 9 months after the end of the tax period. Now let's understand for whom corporate tax is applicable. As per the UAE corporate tax law, corporate tax is applicable to both resident person and non-resident person. So let's understand when a resident and a non-resident person come under the purview of UAE corporate tax law. So who is a resident person? A resident person can be a natural person or a juridical person. We all know who is a natural person. A juridical person is a person who is not a natural person, but it is having a legal existence. For example, a company, it can be established in a mainland or in a free zone. It is a juridical person. And when a juridical person, okay, becomes a resident person. So if a juridical person, let's take the example of a company, okay, a company established in UAE. So a company will become a resident person if it is established in UAE, or if it is established in a foreign country but effectively managed and controlled from UAE. So even a foreign company can become a resident person if it is managed or controlled from the UAE. Now, a natural person, when it becomes a resident person, a natural person, if he conducts any business or business activities in the UAE, then it becomes a resident person. So let's understand, who is a non-resident person. So a non-resident person is a person who is not a resident person, okay, and he should fulfill any of the three conditions. First, he should have a permanent establishment in the UAE. Second, meaning these are, either of any of these conditions should be fulfilled. Okay, so the first thing is he should have a permanent establishment in the UAE, or he should derive a state-sourced income in the UAE, or he should have a nexus in the state. Okay, so tax law defines clearly what is a permanent establishment and what is a state-sourced income, but it doesn't define nexus. So we need to wait for the cabinet decision to understand the term, clearly. So we understood actually, who is a resident person, who is a non-resident person for the purpose of corporate tax law. Now let's understand which are the incomes of these resident and non-resident person are subject to corporate tax. Okay, so let's start with the resident juridical person. Take the example again for a company. Okay, so for a juridical person, let's say UAE established, UAE based company. For it, its global income is subject to tax, meaning a company which derives income from the UAE as well as it derives from outside the UAE, both are subject to corporate tax. Second thing, a resident natural person. For a resident natural person, if he derives an income from the UAE, of course it is taxable. Or if he derives an income outside the UAE, but if it is related to any business or business activity conducted in the UAE, then again they are subject to corporate tax. Third, non-resident person. So for a non-resident person, if any income he derives which is related to the permanent establishment in the UAE or to a state-sourced income not attributable to a permanent establishment or any nexus as determined by the cabinet decision, then they will be subject to corporate tax. So we understood actually for the applicability of corporate tax, it is applicable for both resident and non-resident person, and for which are the income, which are subject to corporate tax. Now we can go in detail about the two terms, okay, in the corporate tax law, which are permanent establishment and the state-sourced income. We know that for a non-resident person, if he wants to, like, if his income are subject to corporate tax, then if a non-resident person is having any of the three conditions, that means one is the permanent establishment, or if he's having any state-sourced income, or if he's having any nexus in the UAE, then his income is subject to corporate tax. We understood that. Now let's understand the definition or the meaning of permanent establishment. So tax law says, if a non-resident person is having a fixed place in the state, okay, a fixed or permanent place, tax law gives a detailed, inclusive list of examples, including building, branch, factory, office, etc., to have a more understanding of about the fixed place. So if he's having a fixed place in the UAE, then any income from such place is subject to corporate tax. Second, if that non-resident person is having a dependent agent in the UAE. So dependent agent means an agent who conducts business on behalf of the non-resident. Conducting business means he should conclude the contract, or he should be negotiating the contract on behalf of the non-resident. Then such agent, we can say it's a dependent agent, and any income through such a dependent agent will be subject to corporate tax. The third thing is that actually any nexus, again, it needs to be defined by the cabinet decision. So for a non-resident person, if he's having any of these three, then that substitutes to a permanent establishment, and then such incomes will be subject to corporate tax. Let's understand the term state-sourced income. Before that, let's see, like, when the tax law defines the permanent establishment, it clarifies few points. As we discussed, if there is a permanent place in the UAE, that we should be treated, that should be treated as a permanent establishment to compute the taxable income of that non-resident, right? But at the same time, we should be mindful that if that permanent place, let's say an office or a building, but if it is involving with the preparatory or auxiliary activities, meaning not core income generating activities, then that office or building cannot be considered as a permanent establishment. And same way, if it is an investment manager activities subject to certain conditions, again, that cannot be considered as a dependent agent or a permanent establishment. The third thing is a temporary presence and non-core income generating activities. Again, that also cannot be considered as a permanent establishment. So these are some exceptions. Actually, tax law provides that even if you're having a fixed place, that itself cannot be considered as a permanent establishment. There should be a genuine core income generating activities. Then only that income will be subject to corporate tax. Now let's understand state-sourced income. That is the second condition for a non-resident to be subject to corporate tax. So if he's deriving any income, any state-sourced income, then such income is subject to corporate tax. Let's understand the definition. Okay, there are three categories of incomes which are to be considered as state-sourced income. If a non-resident derives any income from a resident person, then that income is treated as state sourced income, then it is subject to corporate tax. Second thing, any income paid or accrued by a non-resident person, okay, from another non-resident person, but it is in connection with the permanent establishment. Okay, an income derived by a non-resident person from another non-resident person, but which is related to a permanent establishment in the state, then that should be considered as a state sourced income and it is subject to corporate tax. Then the third point, it says any income from activities conducted, assets located, capital invested or rights owned or services provided in the state. Okay, so it's a very elaborate, or it's a it's something like it is given in very more more detail with so many examples for our easy understanding. So there are inclusive list of examples are given actually to explain the state sourced income. They are the sale of goods in the state, provision of services rendered or utilized, benefited from the state, any income which is related to an asset located in the state, movable or immovable property located in the state, or interest from a UAE resident or a government, or a loan, interest from a loan which is secured by a property located in the UAE. Same way, the insurance premium from a UAE resident or a government, or a premium against an asset located in the UAE. So these are kind of a list of inclusive list of examples provided by the tax law to have a more understanding about what is state sourced income. So I hope you are now clear with the tax effective date, the applicability, and which are the incomes which are subject to corporate tax. Now, my colleague, Mr. Shaibind, he will go into more detail about various interesting provisions of the tax law. So up to you, Shaibind. Thank you.
Thank you, Afzal, for the detailed overview of UAE corporate tax. Hope everyone is enjoying the session. So now let us understand what is the tax rate as per UAE corporate tax law. Before explaining the tax rate, we should know that corporate tax is calculated on taxable income of a taxable person. I will explain in detail about the computation of taxable income in the coming slides. So for an easy understanding, taxable income means taxable profits, meaning taxable sales minus deductible expenses. When tax law explains about tax rate, it is given in two sections: tax rate for normal persons and tax rate for free zone person. For a normal person, 9% corporate tax is applicable on a taxable income beyond the threshold limit of AED 375,000, meaning 0% corporate tax is applicable on the taxable income up to the threshold limit of 375,000. So for a free zone person, 0% tax is applicable on the qualifying income and 9% corporate tax is applicable on the non-qualifying income. So now let us understand this with an example. Just assume a company has a taxable net taxable income of 400,000 AED. So in this case, corporate tax is applicable at a 0% for the threshold limit of 375,000 AED, that is amount 0. And for the balance amount, that is 400,000 minus 375,000, a 9% of corporate tax is applicable, that is AED 25,000 into 9% amount is equal to AED 2,250. So total corporate tax payable is AED 2,250. So we just said that for a free zone person, 0% tax is applicable on the qualifying income and 9% tax is applicable on the balance income. So let us understand now what is a free zone and how a person is being classified as a qualifying person. So in order to name a person or an entity registered in the free zone as a qualifying free zone person, there are some conditions to be satisfied. So the first condition is maintaining substance in the state. Like everyone is aware of what is substance because UAE is already complied with the ESR regulations from the past years. So it is the responsibility of each entity to prove the substance. So in case of ESR, we all know that economic substance regulation policy says that each entity has to keep the minimum substance provisions in the country to generate such revenue. So as far as corporate tax law is concerned, it has not detailedly mentioned about the term substance. So we can expect the detailed clarification on the term substance in the coming amendments. And next point is derive qualifying income as specified in the cabinet decision. And the next point, have not elected to be subject to corporate tax. So each company, whether it is qualifying or not qualifying in the free zone, they have an option to be selected as a taxable person. They can go and choose if they wanted to be a taxable person and come under the umbrella of 9% corporate tax. So the next point comes with comply with the transfer pricing policy regulations. And the last point, the meet other conditions as prescribed by the minister case-to-case basis. At each interval, government or federal tax authority will be issuing amendments to the law, so that has to be complied with. Then till now, we have seen who is taxable under the corporate tax law. So next we are going to see who is exempt from paying corporate tax. So there are two categories of exemption provided by the government. It is like automatic exemption as well as, and there is another category, exemption based on approval. So when a entity itself is exempted from corporate tax, they are not liable to pay any tax or anything on their revenue generated from the business. So let's see what are the conditions to be eligible for an automatic exemption. One is government entities, second government controlled entities, and extractive businesses, non-extractive natural resource businesses. These four categories of entities are exempted from business corporate tax automatically. Next, we will go to the category of based on approval, case to case, entities can claim the exemption. The first one is qualifying public benefit entities, qualifying investment fund companies, pension or social security fund, a juridical person incorporated in the state, fully owned and controlled by government or government entities. Any other person determined by the cabinet decision at the suggestion of the minister. The last point explains when a case or a request goes to the ministry or the concerned federal tax authority, they will take a decision on that, and exemption can be availed by the entities on case-to-case approval basis. So while computing a corporate tax, how we need to find out the taxable income? Everyone is aware that how when we prepare the financial statements, we are following various accounting standards, financial policies. So in case of corporate tax, as per the law says we have to depend on the accounting income prepared based on the accounting standards followed by the company, and it is allowed to make various adjustments onto the accounting income. We will go in detail about the adjustments to be made on the accounting income. It is namely tax reliefs, exempted incomes to be deducted, and various tax losses and tax reliefs, foreign tax credit. All these items can be adjusted to find out the net taxable income. So from this example, you can see on the from this computation table, you can see from the net taxable income, a 9% corporate tax will be calculated on the taxable income beyond the threshold limit of AED 375,000. On that taxable tax amount payable, any withhold tax credit or foreign tax credit or any other credit or relief provided by the cabinet or approved by the cabinet can be adjusted to arrive at the final net tax liability of any entity. So we just said there are few adjustments to be made on the taxable income of any person or an entity. So let's just go through what are the adjustments to be made. First one is exempt incomes, then reliefs, deductions, tax loss relief, unrealized gain or losses, transfer pricing adjustments, incentives or social reliefs for qualifying business activities, and any other expenses or incomes, declared by the government to be adjusted against the taxable income of any entity. So all these adjustments or points are not detailed in the decree law 47, which will be released in the coming. We can expect the detailed inclusive list of what are the items included in each category in the coming months. We are expecting it. So as of now, we will go through some of the important points coming under which we have to be ready with the understanding at the time. The first one is exempted income. So when we say about exempted income are not included in the taxable income of any entity, because if the government says this income is not part of taxable umbrella or bracket, you are not supposed to take that amount into the finding out when you find out the taxable income. So we have few examples of exempted incomes. One is dividend received from a UAE entity. Everyone is aware that a resident company is taxable at the global revenue. So the global taxable income is taxed at 9%. So dividend received from a resident company is exempted, and a dividend received from a foreign entity is exempted on participation exemption, and capital gain and other incomes is also exempted, provided this company is subject to participation exemption. Income of non-resident from operating or leasing aircraft or ships in international transportation. When we say participation exemption, we need to understand little more about participation exemption. So the ownership, now we can look into the detailed what are the conditions to be fulfilled to call an investment or the share of ownership is participation exemption. That such ownership or share should be 5% of or more, and this share of interest should be held, or there should be an interest in the interest to hold for more than 12 months. And this investee company is liable to tax rate at 9% or more. 0% is applicable in the case of a qualifying free zone person, because already they are exempt. And not more than 50% of investee's asset consists of non-qualified ownership interest if held by a taxable person. And like we discussed earlier, any other conditions, these are all inclusive list, any other conditions specified by the cabinet decision. So in the adjustment sector, there are exempted incomes and reliefs, tax losses, etc. So there are, when we calculate the taxable income of any company, all the expenses of the company which related to business will be included in the finding, when we find out the taxable income, or when we make the financial statements, all the companies will consider any business related expenses into their books of accounts. But in the case of finding out of taxable income for the purpose of corporate tax, the Federal Tax Authority clearly mentions some of the expenses cannot be claimed, cannot be, that benefit of reduction cannot be availed for such expenses. Few examples are some expenses incurred in relation to an exempt income. Suppose there is an exempted income for the company, one division of income, which is not taken at the calculation of taxable income. So any expenses incurred to generate such exempted income is not allowed. And next is entertainment expenditure, which is allowed only up to 50%. Above that, it is not allowed. And any net interest expenditure of the company is deductible up to 30% of accounting EBITDA, which which can be, the balance can be carried forward for the next 10 tax periods. So any interest expenditure can be carried forward to the next 10 tax periods, and the first year up to 30% can be adjusted. The next adjustment we are going to see is the tax loss relief. Everyone, we know that the tax losses of any tax period can be adjusted against indefinite subsequent tax periods. But there is a condition that in the subsequent tax period, only up to 75% of the current period's taxable income can be set off against the carried forward taxable losses. And the law again says that there is a condition to claim this relief, and some expenses, some losses, some tax losses cannot be adjusted. Suppose when we go into detail of some examples, tax loss incurred before commencement of corporate tax. Now we have seen tax law is applicable from 1st June 2023, but companies may have tax losses for the previous year, suppose 2022 financial year. Such losses cannot be carried forward in their subsequent period, and loss incurred before a person become a taxable person. Any company or an entity or a person who is not registered as a taxable person and the losses incurred during that time cannot be adjusted in the subsequent period when they are becoming a taxable person. And any loss incurred from an asset or an activity which is described as an exempted income is also not allowed to carry forward and adjust against the taxable income. And as per the corporate tax law, the tax law allows the companies or entities, it permits to transfer the tax loss between resident juridical persons. But the law says there should be a minimum 75% common shareholding between these entities, and both the entities should not be an exempt or qualifying free zone persons, and all the entities taking part of this transfer of tax losses should follow the same financial year and accounting standards. Then only they can transfer the tax losses between the resident juridical persons. So next we are going to see one of the important area of corporate tax law. Like in the case of VAT, value added tax, there was an option provided to the entities to form a VAT group and avail group VAT return and group tax report submission, like that. So the Federal Tax Authority also provides the benefit of forming tax group, but the provisions of the law is slightly different from the VAT provisions. So we can see the conditions to be followed to form a tax group by the group entities. First one is the parent company and the subsidiary company both should be resident juridical persons. And the second point, there should be a holding and subsidiary relationship, and the parent company should own 95% of the shareholding, voting rights, or profits and net assets in the subsidiary. So we should clearly note that apart from VAT law, this is actually very clear. A parent subsidiary relationship should be existing with 95% or more shareholding and right of voting, profit and net assets of the subsidiary. And the next condition is both the parent and subsidiary should not be exempt person or a qualifying free zone person. That means all the group entities should be a taxable person. We cannot have one free zone company which is exempted and having qualifying income, and one mainland company having taxable profit. We cannot form tax group with such two companies. Then the same condition where the group companies should have common financial year and common accounting standards across all the business units. So there are some points which may attract the attention of group companies. The corporate tax law gives some benefits. What is the purpose of forming a tax group? The first one is simplified compliance with the single tax return. That is actually when there is a more than 2 companies and all, they can submit, they can take the benefit of filing the single VAT return and offsetting their tax losses and reliefs against the group taxable income. And transfer pricing policy is not applied on the group tax groups. So that is also one of the main points which we have to note. And provisions of carry forward or losses in case of changes to the tax group ceases to exceed. So we can expect more provisions and clarifications related to this law in the further amendments of the law. And there is another point which we need to consider as a very important point, because when we see individual companies or entities or person, the threshold limit is AED 375,000 for the corporate tax calculation. But when it comes to a tax group, this threshold limit is taken as at one point. Whether there is a company of 2 companies or 5 companies, there is threshold limit is applicable as a group level, but the amount remains the same as 375,000 AED. So this is the point where we have to put our attention a little more in detail. So when we find out the taxable income of a tax group, the methods are the same. Accounting records have been used for the reference of finding out the taxable income. Financial statements prepared based on the accounting policies of the company is the main basis of records, and all the group company financial statements should be consolidated by the parent company. And some of the points regarding the tax losses adjustments we will go through in detail, like one by one we'll go through. It's unutilized tax losses of subsidiary. The subsidiary that joins the tax group become the tax losses of the tax group can be used to offset the tax. Sorry. Okay. Unutilized tax losses of subsidiary that joins the tax group become carried forward tax loss of the tax group. That is a benefit. Then it can be used to offset taxable income of the tax group as it relates to the relevant subsidiary. So these carried forward losses can be used as to benefit and to adjust against the taxable income of the tax group. The next one is unutilized tax losses of the existing tax group cannot be used to offset taxable income of tax group as it relates to the new subsidiary. The third one, tax losses of tax group remain with the group when the subsidiary leaves the group, except for the unutilized pre-grouping tax losses of relevant subsidiary. So when a subsidiary leaves the group, unutilized pre-grouping tax losses relevant to the subsidiary remains the same, and balance amount can be used to adjust the taxable income of the group. In the case of cessation of a tax group, unutilized tax losses can be adjusted in 2 ways, which are: if the parent company continues to be a taxable person, that parent company can use the tax losses to adjust against the taxable income of the parent company. The second situation will be if the parent company leaves the taxable group and that tax losses of tax group is not available for offset against future taxable income of individual subsidiaries, except for unutilized pre-grouping tax losses of such subsidiaries. That means these individual subsidiaries can offset against their portion of unadjusted tax losses when a tax group is ceased. So these are the main conditions which are related to the tax group. And like I said, the detailed inclusive list of items of the law has to be come out. We are expecting it to be out in coming months. And as a part of record keeping, each entity has the responsibility to provide information to the Federal Tax Authority or the concerned department when it is being asked. Because, like being a direct tax, every entity should have the proper documentary compliance, legal compliance, everything while preparing the financial statements. These financial statements are the base for preparing the corporate tax or finding out the taxable income. So in such case, maintenance of proper books of accounts in accordance with the accounting standards, which is IFRS is currently in UAE, which is very much relevant for each entity or industry or any business. And provision of information, documents, or records, these may be asked by the authority whenever it's required. It may be in the first year or in the second year or third year, or after each submission of the return. Anytime we can expect a request from the ministry or the concerned department to supply or to support our computation of tax is properly we have done, correctly done. So the responsibility is lying with each entity to keep the proper books of accounts in this case. And all these records, books of accounts and documents should be available at least for 7 years following the tax period. That is also a very important point. And exempt person must maintain records enabling exempt status. That means if somebody is claiming exemption either automatically or based on approval, and if qualifying free zone persons, such category of entities should be having proper proof of records to prove to the government or the ministry of or the authority that we are exempt from corporate tax liability. So as per the corporate tax law, we have seen the changes or the rules and provisions of the law which is going to be applied in the country. And now what is the next step we have to take? As each business unit is having different strategy of doing the business, different types of accounting methods they have, and maybe they are following their own systematic practices. They are having the requirement to do a impact analysis of the business and their internal policies or their IT system, and find out where the changes are required, where the updates are required, and be prepared for the implementation of the corporate tax law. So the main points for the further steps include impact analysis and structural changes, taking necessary updates about transfer pricing policies, understand what are the related party transactions, maintain proper compliance, documentary compliance and legal compliance documents, all those things, and implementation of technology or IT setup or standard operating procedures they have to update. And once these things are done, next comes the final compliance with the law. And after each tax period, we have to find out the taxable liability of each entity, we have to file the return and go on. So each company has the responsibility to comply with the law and follow all the regulations given by the company. So that's it from the detailed provisions side of corporate tax law. So hope you guys enjoyed it. We'll move on to the next session. Thank you.
Well, that's the end of the session. Thank you, Mr. Afzal and Mr. Shaibin, for the informative webinar. So now let's discuss some of the questions that have been raised by the participants. As of now, there have been only 5 questions which have been asked by the participants. So if anybody have any doubts or questions, you can ask in the question and answer sessions. So the first question is from Ms. Melanie. So the question is taxable income the whole turnover? I thought it will be charged based on the profit. Please explain.
See, corporate tax law use the term taxable income. So taxable income is basically taxable profit, not the revenue. It is not working as it works in case of VAT. So it's always the taxable income, that means taxable profit, And as we already discussed, actually, the profit we will be calculating based on the accepted accounting standards. Of course, in UAE, it is IFRS, and we have to do necessary adjustment to that accounting income, as we already explained. So it is profit and not the sales. I hope it is clear.
And next question is, what is the maximum that can be deducted for salary plus benefits for each employee? Is there a correlation between turnover and maximum salary range?
Yes, as a global practice, we should see, like, if you're understanding the countries' tax laws, there is always a kind of a cap for certain expenses, especially for management remuneration, etc. That is always based on the accounting EBITDA, certain percentage, let's say 10% or 11% of the total EBITDA. That is a maximum cap. It is allowed, and the rest will not be allowed and all. But reading the tax law, we should say that there is no such maximum cap given. Okay, but again, we may have to wait, as it is a global practice to keep such a maximum amount of certain such expenses. Then we should also expect such update from the authority, and we may have to see the executive regulations in the coming months to understand it clearly. But as for the tax law, there is no such maximum cap.
Okay, and also there is another question from anonymous attendee. Okay, it's as an FC LLC, is compensation paid to external consultants outside the UAE taxable, and also bonus is taxable?
See, any personal income, will not be coming under the purview of corporate tax. When we are reading the public consultation document or the FAQs and all, we can see that personal income will not be subject to corporate tax. At the same time, as we read the tax law, even a natural person is subject to corporate tax. So there is, certain incomes again will be subject to, but not like a personal income, like a salary or bonus, or will not be under the purview of tax law. Tax law clearly says that actually, like in the cabinet decision, it will we will come to know in detail what are the incomes, list of income categories which are subject to corporate tax in the hands of a natural person. Okay, whether it can be a resident or non-resident natural person, what are the income which are subject to corporate tax? We have to see from the cabinet decision. But at this point, we can say that the bonus or salary and all actually will not be subject to corporate tax.
Okay, next question is from Mr. Vishwanathan. So, company X has employees working with visas of company Y. How should we handle their salaries and the accounting part for corporate tax?
Yeah, so this is a kind of a question actually commonly people have actually, because here mostly we can see that the company's visa will be in like people's employees' visa will be in one company and they will be working for the other companies. See here, to have an understanding on this, we all know that always the taxable income is the base for computation of taxable income is accounting income. So as per the accounting income, the expenses which are related to that business can be salary or any other expenses, which it's not based on the form but the substance that actually for which company the employees are working, then definitely that the expense should be booked in that company irrespective of the visa. But like there is no kind of a regulation does not say that actually like with the visa or whether it should be in the same company where the expense is booked. But ideally, like we have to make, we can suggest our clients that we should make necessary changes to keep these structural changes, to like the employees visa may have to be shifted to the other company, so that actually there will be a supporting documents for such expenses. That is one thing. The another part actually, like there are cases actually that through intercompany invoicing, if it is a group company and all, actually like it doesn't matter if it is a group tax group, I should say. So if it's a different company and one company's employees is working for the other, keeping the visa in the first company, then we should suggest in such case the necessary structural changes to be done to move the visa, in case it is to move the visa to the right company, so that the expenses booked, the salary related expenses booked, will have a sufficient supporting.
And next question is from Srinivas Rao. Is asking, what about bad debts?
Yeah, see again, what about bad debts? Definitely, is part of the business expenses. Okay, so it should be admissible as an expense while computing the taxable income. There is no conditions so far actually from the tax law that actually is there any related to writing off the bad debts or any kind of a maximum cap or something. Nothing is there so far. But again, we should be expecting certain some provisions related to writing off the bad debts, or many things include like depreciation provisions, and actually we have to wait for more clarity from the ministry.
So next question is, when we need to register a company for FTA and also for an LLC with a single owner, is there a limit for the owner's salary plus benefits?
Yeah, I already explained earlier that actually there is no such cap for the management remuneration so far. But at the same time, we should understand this from the transfer pricing regulation as well, from the point of transfer pricing regulation. So any transactions with a related party, it can be a director or owner, like that should be inconsistent with the a non-related party transaction, right? That is the whole purpose of such regulation. So tax law insists that actually we should always keep the transfer pricing regulation, arm's length pricing policies and all. So so far there is no such a maximum cap for management remuneration, but this point we should keep in mind. And again, as it's a global practice of having such a maximum amount for allowance, then we should expect the same here as well. We should see in the cabinet decisions and all, coming cabinet decisions and all, is there any related provision?
Next question is, if a person outside UAE has a real property in UAE which he rented it, is the rental revenue from the real property is taxable income?
So here there are two things. One is that actually the rental income earned by a natural person. Okay, so if it's a natural person, actually, as I told you, like the personal incomes for a natural person, will not be under the purview of corporate tax. So reading the FAQs or previous communications, we should say that any real estate income or salary or such incomes will not be subject to corporate tax. That's first thing. But at the same time, tax law is not giving clarity over that. Tax law says that the category of incomes for a natural person, can be a resident or a non-resident person, okay, which are subject to corporate tax, will be clarified through the cabinet decisions. So we have to wait for that to understand which are the incomes in the hands of a natural person, okay, which will be subject to corporate tax. Here, apart from that, actually, for a non-resident person, if he's earning any income from an asset located in the UAE, again, it will be constituting as a permanent establishment. When we discussed about the non-resident, we discussed about that part. So any income which is related to a permanent establishment, then it will be subject to corporate tax. But we should know actually which are those incomes which will be coming under the purview to be taxed in the hands of a natural person.
Next question is from Rinju. For qualifying fees on persons, what is meant by qualifying income?
Yeah. See, okay, what is meant by qualifying? So here, when my colleague Shaibin discussed about the qualifying free zone, actually, there are certain conditions, okay, a free zone person to fulfill for it to be qualified as a qualifying free zone person, okay. Tax law clearly says it's only for qualifying free zone persons will be eligible for such preferential rate of 0% for their qualifying income. So here, what is qualifying income? It is not defined in the regulation. When we are seeing the public consultation document and all, we could see certain provision that if a free zone person is having any transactions with a mainland branch, okay, then the mainland branch will not be able to deduct such expenses when it is computing their taxable income and all. So there were a lot of discussions happened on that, but at the end, when the final tax law got published, we could see that there is no such provision. It is somewhat very welcoming for any free zone company, okay. But at the same time, tax law clearly says that actually that 0% preferential rate will be applicable only in case of qualifying income. So we should see again actually for the cabinet decision to understand what are the conditions to be fulfilled to call the income of a free zone person as qualifying income. Okay, so we need again we have to wait for that.
Next question is from Mr. Shobit. What is the book maintenance period to calculate corporate tax as per federal law?
Yeah, so as we know, actually, for, in case of VAT, we know every companies have to retain their records, accounting records, okay, for a minimum period of 5 years. It's not 5 years; it's a minimum period, and even if the authority, is having some suspicion or any thing like any inquiry from the authority, it can go even for further periods. But the minimum actually is 5 years. And when it comes to corporate tax, tax law clearly says that the records should be maintained by a taxable person at least for 7 years. So it is 7 years we have to maintain.
Next question is from Mr. Abdullah. If the company is receiving the revenue for the business which is happening in KSA, is it taxable?
The company is receiving the revenue for the business which is happening in KSA. Is it taxable? Meaning here, whether the company is established in UAE or not. Here, so if it is established in UAE, as it's already explained, for a UAE established company, for its global income, even if it is received from Saudi or it's from any other country, okay, it is subject to corporate tax. So global income is subject to corporate tax for a UAE established company. So here, actually, like based on the double taxation treaty agreement and all, actually, we have the option in the tax law to claim such a foreign tax credit, okay, for the same income if the company has paid the corporate tax in the other country. When we explained about the computation of taxable income, you can see that after computing the tax at 9% on the taxable income, and then we can reduce the withhold tax credit and the foreign tax credit. So based on the the conditions to be fulfilled regarding to DTA and all, then we can go for the tax credit and avail that credit. But at the same time, for the purpose of computation of taxable income, we should consider even the income which is earned from a foreign country.
Next question is, what about receivables? We gave sum of customer year-wise credit.
So here, the question is not that clear actually, because if it is the question is about computation of taxable income, it is not that actually only the cash sales is to be considered. No, both cash or credit, it is the total revenue should be considered as sales, and then the deductible expenses can be reduced from the sales, and then we will compute the taxable income. Okay, so yeah.
So next question is from Rinju. If there is any rule for paying salary to partners?
Yes, the same point I already discussed that actually see there is no such a cap for the management remuneration. The meaning only 10% of the accounting EBITDA we can consider as a an expense for the purpose of computation of taxable income. There is nothing like that actually so far. But it is a kind of a global practice when it comes to tax calculation. So we should expect such provisions. We may expect such provisions actually, through cabinet decisions in future.
Next question is, what would be the effect of withholding tax paid for a business contract with a company outside UAE when calculating taxable income or due tax amount?
Contract or with a company outside the UAE. See, tax law provides for the adjusting the withhold tax credit, okay, while computing the taxable income for a non-resident person, especially. So, for example, if a non-resident person is having a taxable income here, and when the resident person is paying the consideration to the non-resident person, if there is a withhold tax applicable to that, then when computing the taxable income of that non-resident person, they can consider that withhold tax credit actually. But so far, that withhold tax, the tax, there is no such withhold tax, the percentage actually in UAE. But we should we should expect such things in future. But we can, of course, actually, we can get a credit for the withhold tax credit if it is paid against taxable income here.
Next question is from Ms. Cecilia. Does the computations of the revenue is regardless of where you sold, either in UAE or outside the country?
Yes, that is very clear that for a UAE-based entity, okay, for example, a UAE, a company established in UAE, then for it, its global income is taxed. So, irrespective that income, whether it is earned from UAE or from outside UAE, all the income should be considered for the computation of taxable income.
Next question is from Fresher. Is registration compulsory for profit less than 375,000?
No, the registration is compulsory only if that the company is having taxable income, that's a taxable profit above 375,000.
And next question is there any deadline to register the company for corporate tax, and which website should be registered?
The website will be the Emirates tax portal, okay, but there is no such deadline so far, announced by the authority. But on the first stage, actually, like the companies who has to register actually will get an email notification from the tax in the payroll tax authority. So there is no such deadline actually so far yet published.
Next question is, shall we can keep the expenses as gratuity, payables, vacation, salaries, annual employee benefits, depreciation?
Yeah. See, we should get actually a very more detailed, explanation on these areas. But of course, as I clearly said, actually, like the base for computation of the taxable income is always the accounting income, okay, and that is as per the financial statements prepared in accordance with the accepted accounting standards. So any such provisions, depreciation, salary, or such expenses should be considered as the tax expenses, allowed expenses for the purpose of computation. But any such kind of readjustment, especially with the depreciation or such provisions, we should get a more detailed clarification on that actually from the department.
Next question is from Mr. Bilal. Will my organization entities in the UAE be able to be consolidated into one filing group, and are there any benefits in doing so?
Yeah, see, as we already explained, actually, like there is a provision in corporate tax as well to group, the entities for the purpose of, corporate tax, like what we do in, in case of VAT. Okay, But at the same time, the criteria, the procedure for tax grouping is entirely different from, as what we do in the case of VAT. So here we have that option to group the entities. There are conditions like, there should be a parent subsidiary relationship, 90%, 95% of holding kind of, conditions are there. So fulfilling these conditions, a parent company can can create a tax group with one or more of its subsidiaries. Okay, in that case, definitely, we have that advantage of offsetting the loss of one company and with the profit of the other company. Okay, and the benefit of the convenience of filing a single VAT return, so tax return. Actually, in such case, actually, that kind of convenience we have. At the same time, or the most important thing is actually there is no requirement for following the transfer price regulations for transactions between the member companies in the same group. So there are many advantages. At the same time, like we should see that the maximum cap for that the tax commutation, that is the the threshold amount of 375,000, that will be applicable for the group as a whole and not for the individual 3 companies. For example, if you have 3 companies and if you are forming a tax group, then you are not going to get the threshold 3 multiplied with 375,000. No, you will be getting that threshold of 375,000 for the group as a whole. So
okay, next question is from Mr. Staj. If the company have branch in UAE, what should be the treatment of corporate tax?
yeah, if the company is having a branch in the UAE, definitely. See, that means actually, that will be constituting as a permanent establishment. Okay, so for a foreign company, if he's having a branch in the UAE, then it is treated as a permanent establishment, and then the income, in relation to that particular branch, will be subject to corporate tax.
Next question is from Manu. Do we have any arrangements for double taxation in CT law?
Yes, of course. So we have the option to avail the tax credit. Okay, if the company paid the tax for the same taxable income in a foreign country. So based on the tax treaty agreement between the country, the foreign country, and the UAE, then and upon fulfilling certain conditions, then the company can avail the tax credit, while computing its tax. But at the same time, again, we should be mindful that when we are computing the taxable income, we should consider that income, okay, which is earned in a foreign country. And at the time when we are calculating the tax, we have the option to avail such foreign tax credits.
I think we have tried to answer most of the questions. So due to time constraints, we are winding up these sessions. So if you need any further clarification, you can reach us through email or a phone call that's displayed on the screen. So we will be replying for your queries through email or the phone. So thank you all. Thank you all for attending the session. We hope you have learned and enjoyed this presentation. Thank you once again.
Thank you all. Thank you all for your time and patience. Thank you.